All right, let's just get right into it. If you're looking to build wealth smartly and efficiently, starting to invest is one of the most powerful decisions you can make. But here's a fascinating and honestly somewhat unfortunate truth. Most beginners do not lose money because the stock market suddenly crashes. They lose money because of human behavior. They fall into simple, predictable, and totally avoidable traps. Yup, the biggest risk to your portfolio is literally staring right back at you in the mirror. Today, in this explainer, we're going to break down the 5 biggest investing mistakes beginners make. But we aren't just going to talk about them conceptually. We're going to look directly at the math. We'll see exactly how much these mistakes are costing you. And more importantly, we're going to uncover a highly actionable, structured fix for every single one. Okay, let's dive into this. Here's our roadmap for today. 1, the cost of waiting. 2, the all-in trap. 3, the emotional roller coaster. 4, blind spots and hype. And finally, 5, hidden leaks.
All right, mistake number 1, the cost of waiting. Stop looking for the perfect time.
So you've probably seen this before. People sitting on a pile of cash, totally paralyzed by the fear of a crash, waiting for that perfect moment to jump in. But the mathematical penalty of waiting is honestly mind-blowing. Take character A, who starts investing at age 20, putting away a modest $300 a month. Contrast that with character B. They wait just 10 years, starting at age 30. Because they waited a single decade, they now have to invest $675 every single month. They literally have to shovel more than double the money in just to catch up. And what's the goal here? They're both aiming for the exact same massive mountain of wealth, $1.05 million by age 60. They both get there. But character B had to work so much harder, sacrificing a huge chunk of their monthly income, all because they just sat on the sidelines for 10 years. And this really hits the nail on the head when it comes to the danger of trying to time the market. If you try to guess the perfect time to buy and sell, you risk missing out on the market's biggest leaps. Seriously, historical data shows that missing just the 10 best days in the market over a 20-year period can cut your overall returns by more than 50%. Half your wealth just gone because you missed 10 specific days. And the crazy part? Those best days often happen right after the market's absolute worst days, exactly when everyone's terrified. So what's the fix? Well, it's dollar cost averaging, or DCA. Forget timing the market. Focus on time in the market. Set up an automatic transfer of a fixed amount, even if it's just $50, every single payday. You systematically buy when the market is up, and you buy when it's down. You just let consistency do the heavy lifting for you, completely removing all that emotional guesswork from the equation. Moving on to mistake number 2, the all-in trap, or the danger of one basket. We all know the eggs in one basket cliché, right? Picture someone dumping all their hard-earned cash into a single hyped stock or some trending cryptocurrency. The fragile reality of this approach is terrifying. It literally just takes one rock to trip you up. A single corporate scandal, a failed product launch, or a bad earnings report can cause a one-stock portfolio to plummet, sometimes all the way to zero overnight. People often think that because they know a company's name or use their app every day, it makes the stock safe. But familiarity does not equal safety. So how do we fix this fragility? Broad market diversification. Instead of trying to pick the one winning needle in the haystack, you just buy the whole haystack. By using index funds or ETFs, like an S&P 500 fund, you're instantly buying tiny little fractions of hundreds of the largest, most successful companies out there, all at once with a single purchase. So the absolutely crucial point here is this. When you hold an S&P 500 fund, if one company out of those 500 fails or has a terrible year, your portfolio isn't ruined. You have 499 other massive companies holding you up. Diversification spreads your money across different sectors and instantly adds geographic variety. It might not guarantee a massive profit every single day, but it is your ultimate shield against catastrophic loss. All right, mistake number 3, the emotional roller coaster, otherwise known as the daily checking habit. It is so incredibly easy to become that investor whose eyes are glued to their smartphone, practically dancing for green arrows and absolutely panicking over red ones. But let's pause on this foundational quote. The biggest risk to your portfolio is not the market, it's your behavior. Long-term investing is not meant to be a mobile casino game. Human brains are actually hardwired to feel the pain of a financial loss twice as intensely as the joy of an equivalent gain. That anxiety is exactly what causes investors to panic sell at the absolute worst possible times. The fix for this one is beautifully simple, and it actually requires you to do less, not more. Treat your investments like you're growing an oak tree. Step 1, you plant the seed by investing. Step 2, you set up a sprinkler system by automating your contributions. And step 3, this is the absolute most important one, stop digging up the seed every single day to check on the roots. If you don't need this money for the next 5 to 10 years, there is zero reason to check its value on a random Tuesday. Just automate it and walk away. Next up, mistake number 4, blind spots and hype, the classic FOMO trap. FOMO, the fear of missing out, constantly tricks beginners into chasing these shadowy promises of 100x guaranteed gains or throwing cash at complex options and meme coins they don't even grasp. To anchor this, let's look to Warren Buffett. He famously said, "Never invest in a business you cannot understand." Sounds super basic, right? But it's profound. If you're putting your hard-earned money into something you cannot clearly conceptualize, you aren't investing. You're literally just gambling with a fancier name. So how do we avoid getting sucked into the hype? We use the 2-sentence rule. Before you hit that buy button, test yourself. Can you explain exactly how this specific investment makes money to a 10-year-old? And can you do it in just 2 simple sentences? If you can't, do not buy it. Stick to transparent, boring, and proven investments while you take the time to learn. Honestly, boredom in investing usually means you're doing it exactly right. And finally, mistake number 5, hidden leaks, the silent wealth killers. Imagine your investment gains are this giant bucket of water. Hidden platform fees and inefficient taxes are like these little mice chewing holes in the bottom. Many beginners simply do not realize these fees even exist. Let's compare a standard low-cost ETF, charging maybe a tiny 0.05% fee, against a standard mutual fund that charges what sounds like a relatively small 1.5% fee. I mean, 1.5% doesn't sound like a big deal, right? Wrong. That seemingly tiny 1.5% fee is a massive wealth killer. Over a 30-year investing lifespan, that 1.5% fee will actually devour nearly 30% of your total lifetime investment gains compared to holding that low-cost ETF. Think about that. You're doing all the saving, taking all the risk, and giving away nearly a third of your final wealth just for the privilege of holding their fund. No way! Now, what's really interesting is how mechanically easy it is to plug these leaks once you actually know they exist. First, before you buy anything, check the expense ratio. That's just the industry term for the fee. You want to aim for funds with an expense ratio under 0.20%. Second, plug the tax leaks by utilizing tax-advantaged accounts like a Roth IRA in the US or an ISA in the UK before you ever put money into a standard fully taxable brokerage account. So, if you're feeling a little overwhelmed, take a deep breath. You do not need to be a financial genius to invest successfully. You don't need a Wall Street background. You just need discipline, a bit of patience, and to steer clear of these entirely avoidable traps we just went through. By simply dodging these specific errors, you're automatically putting yourself ahead of like 90% of beginner investors. Let's quickly solidify your new long-term game plan. 1. Have a clear plan with a timeline so you know exactly why you're investing. 2. Invest consistently using dollar-cost averaging, totally ignoring that urge to time the market. 3. Stay highly diversified with broad market ETFs to protect against single stock failures. And 4. Control your emotions. Automate your investments, stop checking the app every single day, and watch out for those hidden fee leaks. I want to leave you with a question to reflect on as we wrap up this explainer. Which of these 5 investing mistakes have you been closest to making in your own financial journey? Was it waiting too long, panicking over a red arrow, or maybe ignoring those hidden fees? Identifying your own blind spots is the absolute first step to securing your financial future. Thank you for learning with me today. Stay focused and keep growing.